Long term, I do think gold goes a lot higher. Could it be 5,000? Could it be 10,000? I don't know. I know there's a belief that the U.S. is going to have to try to collateralize, if you will, its treasuries outstanding with gold, and they're going to have to do it at a much, much higher gold price because they don't own that much gold. And you mentioned gold. I mean, gold is definitely perked up, and I think that's a worthy discussion to have. Is how well is the stock market doing in real money? Because I think so much of the appreciation we've seen in recent years has been a function of currency debasement. So, if you adjust S&P returns for the price of gold, they don't look too good.
The gold market may be stuck below $2,350 for now, but that hasn't stopped prices from achieving new records. Friday's close marks the end of the second quarter, and the precious metal has notched a new all-time record quarterly closing price for the third consecutive quarter. The yellow metal is ending the week around $2,336 an ounce, up more than 5% from the end of the first quarter. Meanwhile, on an annual basis, gold prices are up a whopping 21% from the end of the second quarter of 2023. The Haymaker, David Hay, is optimistic about gold's long-term prospects, suggesting it could reach $5,000 or even $10,000. He mentioned that the U.S. might need to collateralize its outstanding treasuries with gold at a much higher price, given its limited gold reserves, which could further boost gold prices. In a June 24th Shift Gold report on Ahead of the Herd, it was noted that inflation is going to keep going up. That's why gold is rising. It's a signal that the monetary policy is wrong. In fact, they should be raising interest rates. But the gold traders know that Powell is too afraid to raise interest rates because he'll cause a financial crisis. Furthermore, the report emphasized the potential growth in mining stocks, with the GDX index of senior gold mining stocks up 7%, and the index of junior mining stocks up 9% in the same week, indicating strong investor confidence in the sector. Hay observed that gold often rises about 20% and then consolidates, which is consistent with recent patterns. Furthermore, he acknowledged the volatile nature of commodities, advising investors to periodically take profits during strong rallies. However, he noted the challenge of investing in palladium equities, recommending ETFs as an alternative. Before we jump into more content, consider subscribing and enabling notifications to stay updated with our latest uploads.
I'm happy that it's gone up because we own a lot of gold-related securities. But as you pointed out earlier, it did pull back a little bit, and it's been a fairly controlled move. But we're big believers when an asset class or security makes a multi-year new high, in this case, an all-time new high. That's a very bullish signal. It typically will keep on going. Now, oftentimes, interestingly, it goes up about 20%, then it kind of consolidates, and that's exactly what we've seen so far. But long term, I do think gold goes a lot higher. Could it be 5,000? Could it be 10,000? I don't know. I know there's a belief that the U.S. is going to have to try to collateralize, if you will, its treasuries outstanding with gold, and they're going to have to do it at a much, much higher gold price because they don't own that much gold. That could happen. That's certainly one of the upside kickers. But I guess an easier way to play it is to look at the miners where they have lagged so significantly, though some of them have really good moves lately, but there's still some that have lagged that are starting to report very positive earnings surprises. We wrote one up actually yesterday in our newsletter for our paying subscribers that it was courtesy of Fred Hickey. Fred, you should have Fred on your show if you haven't. He's terrific in the gold space, and he knows the gold miners inside out. I'm a subscriber to the service. I'm also a friend, and I've made a lot of money buying Fred's mining ideas. So I think that's a way, particularly on any weakness, to take advantage of this gold bull market, which I do think is still got a lot further to run. But it's going to be wild. And I think when the trouble with commodities, and I see this all the time in energy, is they hear the story and they go, gosh, it sounds like energy's got to go higher. And they buy it, it runs up, they buy more, and then the correction comes. They go, oh, God, that was a bad. I'm now down because of buying at a higher price. And so they give up on it, and then they miss the huge move. So you have to. I think part of it is when you do get these strong rallies that happen periodically, take a little bit of money off the table, and we've actually done that with the precious metal related securities. We've taken some money off the table into this rally, but we're prepared to buy back again. And actually, if you wanted to talk about a commodity, a metal that I think has got tremendous upside, I'd bring up palladium, which is one of the most disliked commodities out there currently, industrial metals, because it's viewed as being buggy whipped basically by what's happening with EVs. EVs don't use palladium, but I think what they're missing is where the real rapid growth is for kind of new age autos is with hybrids, and hybrids actually use more palladium than do internal combustion engines, and that very few people are aware of that. So that's I think that's a very unfortunately it's very hard to play with equities with
Hmm.
palladium. There aren't very many that you can buy, but the palladium itself is quite easy to buy in the form of an ETF. The analysts have not raised their numbers for this higher price, and margins, according to Fred Hickey, and I think he's right, the margins are going to be up like 40%, and yet the estimates are basically what they were when gold was still 1900, 2000. So I do think there's a definite potential for some very positive earnings reports that finally get the attention of the analyst community. Because gold, I mean, we're getting even the miners look at gold ETFs. I mean, they're still getting outflows from gold ETFs, not inflows. So there's tremendous apathy towards this area. But the miners, if gold is neglected, miners are detested.
The economy is the key battleground ahead of November's election. But economists and investors are increasingly concerned that neither Biden nor Trump are prepared to be tough enough on issues such as spending. Stocks have generally performed better than gold over the years, but there can be exceptions. Looking back 20 years, for example, gold has outperformed the S&P 500. The price of gold and the S&P 500 both reached new record highs after the Federal Reserve signaled that it's still expecting to cut interest rates this year. Both assets have had a strong first quarter so far in 2024, and as they reach new all-time highs, you may be wondering which is the better investment. With all that in mind, it's no surprise that gold gained momentum when Fed officials indicated last week that they expect 3 interest rate cuts in 2024. Hay concluded by highlighting recent commodity price movements, particularly gold, and questioned the true performance of the stock market when adjusted for currency debasement. He emphasized the importance of considering real returns in terms of purchasing power, given ongoing economic challenges and inflationary pressures. Let's now turn our attention to the video again.
I think it's tough. I mean, well, what I do see is that you see reports of the hedge, well, certain countries being big buyers of treasuries, like Luxembourg, and I think another one is Cayman Islands. But these countries that are rather very small, but are yet huge buyers of treasuries. How can that be? Well, I think it's because they're basically conduits for hedge funds. So I think that's what's making it a bit trickier too. Even if you do identify that data could be misleading, but what's clear is the major foreign central banks are divesting or not increasing their U.S. treasuries. So with this tremendous surge of issuance, uh, who's picking up the slack? And I think, frankly, what's happening is it's a lot of U.S. retail and the banking system, which have been the main buyers, because the Fed, as you kind of alluded to, is no longer, they're not doing QE anymore. They've been doing QT, which is where they shrink their balance sheets. So they've actually been letting their bonds mature. So you've lost the two biggest buyers of treasuries between foreign central banks and the Fed. So I think that's why you're seeing this dynamic in the treasury market where so much of the issuance is at the short end because the long end is very fragile. And you would think that with short rates higher than long rates, they would want to sell some debt further out to lower the interest costs. But when they try to do that, it seems to swamp the market. So it's a problem, and there's just no two ways about it. It's the Treasury and the Fed have got themselves into a very difficult situation. And personally, I think the only way they get out of it long term is with kind of stealth inflation, and where they tell you inflation's 2 or 3%, and yet there's actually if you've heard of this Chapwood Index, they just did an analysis of the actual cost of living in the 50 largest U.S. cities last year, and it ranges from like 8 to 13%, way above the official inflation number. It was the same thing in 2022, and just as a person on a personal basis, that's what my wife is constantly telling me. She power shopper. She goes to the grocery store and she's saying these prices aren't up 25% from 2019. They're up 50, 75, 100% or more from where they were in 2019. And I think a lot of people feel that way. And if you look at like the CPI doesn't include the cost of homeowner insurance, and homeowner insurance was up last year about 30%. So there's a lot of funny stuff going on with the inflation numbers, and some of it I think is just there's a lot of noise. There's some things that are up, some things are down. There's definitely been cooling when you talk about commodities. There's been a lot of commodity price weakness over the last couple of years until recently, And you mentioned gold. I mean, gold has definitely perked up, and I think that's a worthy discussion to have. Is how well is the stock market doing in real money? Because I think so much of the appreciation we've seen in recent years has been a function of currency debasement. So, if you adjust S&P returns for the price of gold, they don't look too good.
The dollar index posted a slight monthly gain, indicating that gold investors largely ignored the dollar's strength. Throughout June, gold traded within a narrow range, peaking just above $2,387 and bottoming just below $2,287. This marked the first month since February without any new record highs, following a series of all-time highs in March, April, and May. The consolidation paused the rally, but no significant reversal patterns emerged to concern bullish investors. After a quieter June, the bullish trend might resume this month. We want to hear from you. Feel free to leave your thoughts in the comments, give a thumbs up if you liked what you saw, and subscribe to stay connected with our ongoing exploration.